Welcome to episode 82 of Kontrarian Korner. I'm Ben Kellerin. Today we have a very special return guest, and I think the perfect guest to talk with us about everything precious metals, everything else going on in different commodities markets. And I think it'll be a interesting conversation. I'm sure we'll get into the recent events with silver, what's going on with gold and precious metals, what's going on with the broad commodities complex. And I think it'll be definitely a very timely conversation. So Vince, thanks for coming back.
Hey, thanks for having me, Ben. Good to see you again. Always good to be here.
Yeah, no, I appreciate you taking the time. I know it's a little bit hectic with the holidays coming up, but we usually get started with gold. But I figured with what's been going on in the last month or so, it'd be more timely to start with silver. I'm sure everyone's trying to figure out what's going on. Like, what is the 30,000 foot view?
Right.
Like, what can investors expect heading into 2026? All those high level topics, and then we can dig down from there.
Okay, yeah, that's a good idea. So why don't we start with, if it's okay with you, I think I don't know how familiar your people are with it. So why don't I just kind of boil down some of the bigger picture stuff for them, and then we can get into the nitty gritty, which is really where the news has been over the last couple of days. Is that all right?
Yep.
All right. So silver. All right. The broad strokes that over the last 2 years, and certainly more obvious over the last 6 months, is that there's a physical shortage in London. And that physical shortage, I have some notes here. That physical shortage it matters in London because the people that do have the metal are just not making it available for lease. And in the metals world, you will lease silver out to give it to someone who's taking delivery, and then you'll repay the lease with metal at a later date. So if you have someone who's got mining that's going to come out, copper, you do that as well too. But going through the other surrounding things, so you've got London has a shortage, right? They've been relying on leases for too long. They've been trading a contango market that's backwardated. Let's put it that way. That's what they're doing. If you look at it from an energy point of view, the BRICS have been pulling metal seemingly in a round robin. It's India buys it 1 month, and then China buys it the next month. It definitely seems like it's coordinated. Then you had the U.S. repatriation this year, and that brought a lot of metal back, and people still don't know why that's happening. I believe it's happening because right afterwards, even though no one's connecting this dot, Trump declared silver a critical mineral. So if it's a critical mineral, that's also bullish for it, because what a critical mineral does is it allows the government, without asking for rules or permission or disclosure, to start hoarding it. So the government's now hoarding silver, whether they say they are or not. Right after that, China restricts its exports. So there's like a world war metals, or a metals war going on here. And one of the things that caught a lot of people's attention was the lease rate spike. And the lease rate spike was a manifestation of China not having metal made available for London, and London needing to get it. So that's the bigger picture, and that will lead to higher prices over the longer term as well. But you want to do current events, because that's actually where the fireworks were, right?
Well, I mean, I think it is interesting to see like the supply chain for some of these different metals starting to maybe not break down, but at least shift meaningfully. But I think if we could get into some of the recent events and what you're kind of seeing that is potentially going to drive silver higher, and what investors should be aware of as we kind of look ahead to next year.
Okay. So you just want to touch on the recent events, right?
Yeah. I mean, high level, we can get into like the Indian pension funds are buying, and U.S. other, and like all these different events. Yeah.
So, well, just as an extension of everything I just said, the current events are basically this. London is caught in what I would call a rolling squeeze, very similar to what happens when after COVID, when OPEC was jacking oil up, and we were selling out of the SPR. Now, oil was at a lower price, not lower than this now, but it was still backwardated. So there was still short-term demand because people needed it for gasoline and for heating oil. So the gas cracks and the heat cracks kept oil backwardated, even at a high price and even at a lower price. And so you have the silver equivalent of that now. And what I mean is this is not going to end anytime soon. If you're bullish, you don't want it to end anytime soon, obviously, because if it ends anytime soon, it'll end from a massive spike, $100, $150, $200. I don't know what the price is, but if you have that kind of attention on the market, you will definitely have rules changed, and you'll have force majeures declared, and it'll be a disaster reputationally. But what I think is happening now, and I feel strongly about this, and I think the metals people will start to see it my way soon, and that is the London intermediaries, the banks and the ones that are getting lifted on the OTC metal, kind of like doing wet barrels in oil. They are financializing their problem by rolling their longs, rolling their shorts because they're short spot, rolling it back. And so what they're doing is they're creating a backwardation by deferring their problem. And they're going to keep doing that until the silver becomes available. So I think what you're going to see is a rolling, slow short squeeze, and you have might have a steep backwardation going out for, I think, a couple years. Now, that's the current events, the margin raise at Shanghai that was supposed to make the market drop. By all rights, silver drops when you raise margins because it's always the longs that are over leveraged. Well, Shanghai rallied because they have shorts over there that are over leveraged. There are a lot of people in China that are short silver. It's usually the speculators that look at the U.S. and say, "Oh, the U.S. will keep it down for us. We'll sell it." Guys, the opposite of us, the opposite of me. I'll buy it now because China will bid it up. You're always playing the time zone.
Yep.
So you had the margin raise, you have the rolling short squeeze, you have the Black Friday blackout. CME shut down all of its futures, right? But the one that stuck out was silver because it was during that time frame that silver spiked. It was during that time frame that China's exchange had a massive short order try to cover. Allegedly, it could have been a fresh buy order, and it was during that time that one of the massive major bullion banks in the U.S. Changed the availability of their metal from registered, which is available for delivery, to eligible, which is not available for delivery, at least not immediately. And
that was J.P. Morgan, correct?
You said that, not me. Yes, it was. It was J.P. Morgan. And there are legitimate reasons to do that, but the point is, it was done. And no matter how you look at it, they're protecting their stockpile one way or another. I'm not saying they're losing money or making money, or there's a rumor going around that they flipped long. They can do that. They may have done that, but there's nothing credible out there yet. I would just say this: if I were a big bullion bank like J.P. Morgan, and I have been getting picked off by China for the last 2 years, because that's what China's been doing. China's been squeezing anyone who comes into their domain to play. I'll be like, you know what? I get this game now. And I would just make sure that I wasn't on the wrong side of that anymore. And I think they're smart. They're not dumb. Going back to Blythe Masters, when she used to pick my pocket, I'm pretty familiar with that. But in terms of a prognosis going out for the next year or two, I do have a quantified objective, and the quantified objective is based on, of all things, because you really can't tell what it's worth. You can't. It's a commodity. It's not energy. It's not used. You can't handicap energy demand. Silver exists. It's always there. I think the simple way to look at it is when the U.S. listed lithium and uranium as critical minerals, within 5 years, they tripled in price. So when we did that, it was like I actually quantified. I did a post on this. Silver was at about $40 when that happened, when it was announced. And I did the math, and using lithium and uranium analogs, conservative to aggressive, the answer is within 3 years, silver should be trading at $143. Now, do I think that's going to happen tomorrow? No. Do I want it to happen tomorrow? No. I want it to take its time getting out there, but if it does happen tomorrow, I would take profits. It'll probably go to 250 then, but that's the way to do it. So I do believe that there is a realistic analog for the price of silver to go to $143. Now, pure technicians are looking at it in a slightly different way and coming up with similar numbers. So how much does silver move in the last rallies, last bull markets? And you're getting numbers like $150 to $200. I just want to see it get to 70 first, but that's me. So I don't believe there's anything that's going to get in the way of silver rallying short of the black swan that would be China completely collapsing and having to puke, which we've seen worse things. We've seen things happen like that, or the U.S. and Russia and China hugging it out and just loving everyone again. So I think that's it. I mean, there's another driver that we haven't discussed, but I want to throw it out there. This is a big picture thing. The higher gold goes in price, the more precious silver becomes, because the central banks that are buying gold, they're not buying it to flip it or buying it to sell it. The BRICS are going to be using their gold for collateral for financing. So you and I can't take our gold to the Fed and put it out a window and say, give me $1 million. We can't do that. But China's going to do that. China's going to let people bring their gold to the window, and it's going to compete with treasuries. And when that happens, there'll be less gold available, which is why India is buying silver, which is why Latin America has all this silver, which is why India is actually telling its people they can use silver at the window for collateral. So if I'm a middle-class person with silver jewelry, I can take it to the window and they'll give me cash for it. I don't have to sell it anymore. Silver's not going to get sold. There's less selling of it now. And I think that's a big deal. So I'm sustainably bullish on silver for the next 2 to 4 years.
Yeah, I think it is interesting because I think what you're probably already starting to see is that as the price starts to potentially feed on itself, I wouldn't be surprised at all if you're going to see investment demand here in the U.S. for the physical go up as well. And right, people are calling it a Geffen good or some of these different things, but I mean, you look at where gold is, you look at where a lot of people are not going to go drop whatever it'd be, 4,500 an ounce after the premium to buy an ounce of gold, right? And so
that's right.
You look at silver, I think that's a interesting investment demand, and there's obviously the industrial demand tailwinds that a lot of people have talked about. But at the highest level, do you think it's kind of a sign that like the physical market for silver is starting to like basically assert dominance over the paper markets? Is that kind of what we're in the process of seeing?
I do. That's a good point. The gold market, it happened over the last 2 years. And that was a reaction to many things. One of them being Basel III, which reduced leverage necessarily. The silver market, everyone got short silver when the gold shorts covered. You can almost see them parking their shorts, so like a carry trade. But now the silver physical is going to dominate. Now you brought up investment demand, and that's a good point. Investment demand, while it's significant, is not dominant anymore. And the higher gold goes in price, the more likely you're going to see people buy silver. And they're already long it in India, and now they're not selling it. They're being instructed to buy it in other countries. And if you just look at what's happening in gold, I mean, just to quote John Paulson from 2021 when this all really started, he said, I'm buying gold. It was trading 1,700 an ounce. He goes, I'm buying gold because there will be less gold available to invest in 5 years from now, meaning it's going to be taken off the market. And he was spot on right. Staying with that theory, the less gold there is available on the market, the more likely people will turn to the alternative. And there is really no alternative to gold in the sense that it's metal. It doesn't rust. It doesn't corrode. It can't be destroyed. It can't be synthesized, at least that scale yet. And it's really not used. It's perfect as money because it is a pet rock. Silver, on the other hand, is industrial, and so they don't want it to go up in price. But as gold goes up in price, it will snap silver to it more in line with its ratio in earth. 15 to 1, 30 to 1, 7 to 1, depends on who you talk to. So I believe this ties into the bigger picture of commodities that you want to talk about. I believe as gold stays up and there's less of gold available, they don't have to confiscate gold from us this time, Ben. They're not going to do that. It's going to go up to $10,000 and you're not going to be able to afford it. Just like, you can't afford a Bentley. I don't know, maybe you can, but you get my point. Like the point
Not
is
yet. Not
people
yet.
get priced out of it. It's getting priced out. That's a new economic regime right now. People are getting less money for debt. You're borrowing money to buy McDonald's now. And so they can't afford the lower middle class and below is just priced out of gold. And so they're going to buy silver. And I think this is significant. I've talked about this with my subscribers, and I want to share it with you publicly for the first time. If you talk to technicians like Michael Oliver or Jordan Roy Byrne, people whose opinion I value, they will talk about, they use analogs of the past. When it did this, it could do that again. Or they'll use the gold-silver ratio, and they'll say, well, the gold-silver ratio could make its home in the 60 to 50 area. These are technical, historical points that are accurate. And I'd like to throw a reality or fundamental reason on why silver would continue to go up when gold makes a high. And by the way, and platinum, and oil, and copper. Palladium too, but I'm not so sure about it. And the reason is, for the last 40 years, we've been told, well, gold's a proxy for the dollar. If the dollar's strong, gold's down. Well, that's not the case anymore. And those correlations are broken. We cataloged that at GoldFix, like early on. Like no one was paying attention to that. We're like, well, this correlation is not working anymore. What's the new correlation? What's the new correlation? Well, the new correlation for gold was, well, the central banks are buying it. The new correlation going forward for silver will be central banks are buying it. Now, I don't think central banks should be buying silver, but what I think doesn't matter. Russia has announced that they're buying silver, and they are. The Saudi Arabian, I think it's Saudi Arabia, central bank bought SLV. So these central banks are buying silver. Maybe they don't want to store it because it's so much bigger, but they're getting silver exposure. And I think as a nod to the technicians, that when there are no more financial correlations, the dollar rates, who cares about those? Oh, there's no gold left. What do we buy next? I don't know. What's more rare? What's less rare? What's the ratio of silver in the earth? What's the ratio of silver mined? And so you're going to start seeing things like 15 to 1 start to come up, or even 7 to 1 if you're looking at mine. So I think the rarer a metal is, or even if it's less rare, it's going to start to trade at its fundamental natural ratios, which puts silver higher because it's priced at 61, but it occurs at 15 to 1, which puts copper higher, although I don't know what the ratio should be for that, which puts platinum higher. And I know you know about platinum. So
yeah,
that's what I think the bigger picture is. All commodities are going to be, it's kind of like the Game of Thrones when the Ice King is resurrecting people. That's what he's doing. It's like gold is going, okay, everyone get up now. And that's happening now. Plus there's fundamentals involved.
Yeah. Well, I think one of the points you're kind of making there is you're seeing that tug of war a little bit between silver as an industrial metal versus as a precious metal.
Yep.
But you also see it in kind of these different ratios. And that's maybe the kind of perfect segue to get into gold and what you're talking about there, because, right, if gold is leading the commodities like bull market that I think is probably coming, like you're probably going to see what we're starting to see now, where a lot of these different commodities are breaking out to all-time highs, or right in the case of platinum, right, highest level since 2011. Like all these different charts are basically saying, hey, like it's time to wake up and pay attention to the rest of the commodities complex. But what are your kind of thoughts on gold in particular as we kind of look ahead? Because, right, like you said, it's becoming not unobtainium yet, but it's heading that direction. But what are your kind of thoughts on gold for 2026?
I mean, a big 10 to 20% sell-off is possible. If you're looking at the analogs of the 70s, if you're looking at the bull runs, we could be close to a 10 to 20% sell-off. I don't know the reason, and I'm not predicting it. I'm just saying you have to be prepared for that. Now, if that materializes, or if it doesn't materialize, my target for 20, and I do, target's not the right word for it, but I subscribe to what a combination of people are talking about. So Jeffries put a number at 6,500. They didn't put a date on it, and it makes sense. And the number 6,500 is an example of the ratio of gold held per capita would be similar to the ratio of gold held per capita in 1980. So 6,500 puts gold at, like, I don't know, let's say 6% of each holder's net worth. Then Goldman, and this is why it's going to go. This is why it would go higher than that. Okay. What you're seeing throughout the world, and it's starting to happen here, and I think your viewers are going to, if they just think about it, there's a progression here. Central banks started. There's going to be an increased encouragement, incentive to buy gold. So let's look at what's happened in the last year, just in the U.S., right? Over the last 2 years, Costco starts selling gold bars. Gold goes up even as inflation is dropping. I mean, let's be honest, that's what's going on here. This is not inflationary gold. This is accumulation gold for a new monetary order. But nevertheless, you have a massive pool of money that is completely woefully underinvested in precious metals. That's the 60-40 crew. 60% stocks, 40% bonds. And over the last 6 months, you've had Goldman say the 60-40 is dead. You should put some money in gold and oil too. And I'm like, okay, I'll buy that, but let's see if anybody listens, right? Nobody listened. Gold went up, but they didn't listen, right? JP Morgan says that. Then Morgan Stanley comes out and blatantly says 60-20-20, and it's starting to happen. But the needle has moved. Gold's gone from, depending on how you measure it, gold's gone from 5% to 6%. But for it to be where it was in just 2011, it would have to be over 11%. Okay, of these 60-40 portfolio managers. So the needle's moved, but there's a ton of money that's going to come in. And you know what? Nothing against these guys, but this is not the smart money. Okay, and I mean,
big money.
Yeah, it's the big passive investing money. It's the I need to buy it, so I need to buy it. Like the 401k money. I mean, it's the same knuckleheads that have just been buying stocks blindly are going to start buying gold blindly, and it's going to start that down the road. And when you add on top of that, you've got the 401k rules changing. You can own gold now, starting I think February or March. India is adding it to pensions. I mean, it's just it comes back for silver to what you said about industrial versus investment. Investment demand is now competing with industrial for metal. Now, in gold, it's investment demand from pensions is going to start competing with the central banks, who are already dealing with the normies buying ETFs. And that's not near its high yet, but that's moved significantly off the lows. I think there's a lot more room to go. So in terms of gold pricing, that means the physical could go from anywhere from 6,500 to 12,000. I don't know, but I think barring a 10 to 20% sell-off, 6,500 should not be a problem. And that is why I think we have to look at miners.
Yeah, that's right where I wanted to take it next, because especially with what you're saying about the investment flows, like a lot of that is going to end up in the miners, and it's interesting to see the silver miners getting, not having a great day today, even with silver up above 63. So I think that'd be interesting to kind of get your thoughts on when the miners are going to start pricing in, hey, like $60 silver is here and potentially more, but like I look at some of the valuations on the silver miners in particular, and they're not pricing in 60. Like a lot of them are still like looking at, oh, like 40 an ounce, like great. But what are your kind of thoughts on the money that's going to flow into some of the miners, gold and silver, some of these different sectors? If you like one in particular, I think that'd be interesting to hear your thoughts.
Okay, well, I haven't done the work on the silver miners yet because I'm focused on the gold miners right now. But the concept is the same. See, there are two factors. When we're talking about miners, we're talking about what's going to get them to a value that's more appropriate given the price of gold and silver. And the answer is significant continuous demand from normal investors. And right now, tech stocks are still working for them. Now that's changing, but right now that's happening. So that's the first thing. The first thing is you have these fund managers that are still 60-40. And they're not putting much money into gold or miners. That's the first thing. The second thing is you have a psychology that's decades of damage. Now, miners weren't really good self-promoters. For decades, they were horrible at hedging their risk. And then they became too frugal, and then they overhedged. And now nobody wants to touch them, but they've been profitable and well-run for a decade. Well-run. Like, these are really well-run companies with massive free cash flow that nobody cares about because something is more flashy or attractive. And that's fine for now. So the question is, what snaps these people out of it? I think we're in the beginning of the snap out of that mindset now. And I don't usually say this is going to be the day it happens. But I think we're in the beginning of that mindset now, and we're in the beginning of that mindset because I'm seeing it in stock rotations from tech to cyclicals, out of consumer into cyclicals. I'm seeing that, and I'm seeing and miners are part of that. Now, your point about when the psychology, the damage of psychology. Let's look at gold. When gold was in that trading range from April to August. It was the beginning of April, middle of April to the end of August. Big ranges, but nowhere. During that time frame, that's when miners exploded. And the reason that happened is because someone said, wow, gold's not backing off. Maybe I should buy some miners. The psychology of the market is so like, oh, gold never stays up there long. Gold never stays up there long. But that's over. Not to mention, I think the banks are buying miners for their own portfolios because they see what's happening. So if you want to look for the pattern to repeat itself, when gold starts going sideways again, maybe we start seeing miners go up again. And I say that because that's really kind of how it goes, at least recently, unfortunately. Like, for example, so now we go to silver. Nobody believed gold would stay above $3,000 until it went to $4,000. And at $4,000, they said, okay, I'll buy some miners. Now, nobody believed silver would get above $40 until it goes to $70. Like that's where we are. We're in fits and starts. And by the way, that's where that whole 60-40 group is going to come from. They're being told to sell bonds and buy miners. That's their gold exposure. And a small fraction are doing that. But what's going to happen is when we saw those sell-offs during that 4-month time frame, when stocks got hammered but miners went up, what's going to happen is it's not going to be 60-20-20. It's going to be 50 tech stocks, 30 bonds, and 20 cyclicals. So they're going to start puking their tech stocks and buying cyclicals, and that will be and natural resources, and that will be where the miners catch their bid. In the meantime, I'll give you something I'm focused on right now. The streamers in gold, to give you an idea of the disparity, the streamers in gold are basically the upside of gold without the headaches. I'm sure your people understand them. The streamers, they're like MLPs in energy used to be. The streamers, they're pricing gold at about $6,000 right now. That's how much stupid excess demand is in them. Completely irrational because now you've got legitimate gold. El Dorado, is pricing gold at like 3,300. It doesn't make sense. So we should be selling streamers and buying miners, but we don't do that because we know that the streamers don't have the risk. The market is underpricing how well these miners are being run now. And I think they're going to suffer. They're going to suffer when you see tech stocks sell off, and they're going to sell off. So in terms of names, I have a list, but I hesitate to. On the silver side, it's pretty easy because there's not a lot of them. PAAS, the banks love them, and everyone talks about it. I would prefer something that's First Majestic. I like First Majestic, and something that has the ability to get to move up and down the supply chain. And I think some of these firms are doing that. I'm not really sure specifically. I buy a basket is what I do, and I'll buy First Majestic as well. On the gold side, well, I focus on the commodity, and I look for well-run management. I don't look for undervalued gold stocks. Like the first one I bought was Newmont, a couple of years ago when Druckenmiller bought. So that's basically it. I want to keep it simple, but I think if you want a gold miner that's probably got a lot of upside, you want to find one that's eyeballing copper acquisitions. That's what I think. I think because copper and gold do coexist in the ground a lot more frequently than gold and silver, and I think the gold miners that have or are getting copper acquisitions are a good example of what you want going forward.
Yeah, no, it's definitely interesting because I think the thing that'll be I'm curious to see how long it takes with some of the silver miners, but when you do start to see that rotation, a lot of people have called it like it's going to be like trying to shove the Hoover Dam through a garden hose, right?
Yeah.
Just because of the size of the sector. But I think it will be pretty interesting because like you start to look at some of these companies and some of them, like there's a couple off the top of my head that I can think of where it's like the valuation on this is a joke at $40 silver,
right,
at like 60 or 70 or wherever we're headed in the next year or two.
Right.
You're starting to get like, okay, this thing is already printing money, but 3 to 5x in the next 2 to 3 years is not like out of the question. So I think it does make sense to have a basket approach, and like the money's going to find the big names first, but I think it's definitely a place to look. So before I move on to platinum, I do want to kind of detour back to silver and just ask like a high level question.
Sure.
And have you seen the talk about the Samsung silver, the solid state battery? Have you kind of dug into that at all?
You mean the most recent video that's circulating around there?
Yeah.
Okay. All right. Let me just say what a bunch of shit that video is first before I tell you that he's not lying.
There's some like questionable demand numbers in there. I was like, I hadn't heard of the technology, but I was like, yeah.
I think as Americans, we're not familiar with what I'm about to talk about. We're not familiar with blatant propaganda. That's probably propaganda from Asia, could be Korea, could be China, it could be even be Japan. But I mean, it's a new account. That's an AI. That's not a person. That's an AI.
Yeah,
that's like
definitely.
Right? So, but we know that, right? Okay, so now that's the hype, and it's circulated so fast. How did that happen? It's brand new, and it's how did that happen? Are we all looking for this guy? No, there's hype going on now. Now that I've said you got to be careful that Americans are not exposed to foreign propaganda. Well, we are now. Social media does that. Influencers. Now that I've dispelled that video, it's very real. Okay, so I'll tell you. First, let me tell you a quick little story about my education in silver. When I started trading as an options trader, it was 1994, and during that time, I knew nothing about fundamentals. I was a derivatives trader. I still didn't know much about fundamentals, but over that time period, I was on my, my dial-up modem at night, looking up everything on silver. And I found out that silver was used in solid state batteries for the lunar rover. And the reason they're not using it is because it's too expensive. They needed too much metal. And if they ever improve on it. So from then on, I've been following the solid state battery thing. It's kind of like a hobby. And here's what's real. The solid state battery technology is really being worked on by Korea and Japan. And I'll tell you what I know about Japan. If you remember, during the hybrid revolution, Japan won that. That was the Prius, right? And then the electric car, the EV came out. There are no really well-known EVs out of Japan. They missed that boat. I have a friend who works at Toyota. They missed that boat. They know they missed that boat. And now and then they decided about 5 years ago to really start focusing on the battery technology. So Samsung, which is Korean, and Japan, they're working together on this. That's going to happen. Is it going to happen tomorrow when that video said? I don't know. I mean, I don't know. It could, but I'll tell you what it is going to do. It's just going to make anyone else who's thinking about buying just buy that much faster. And the solution, the EV battery, the problem with it is, among other things, it's too long to charge, occasionally blows up, things like that.
Might set your house on fire,
Yeah, exactly. Right. Exactly. Do you have a garage for your car? Well, maybe you shouldn't leave it in the garage, You have to get special insurance to park your car in your garage now. So I can see the solid state battery, especially with carbon, moving to another level. And that level will be impressive. And it'll be more stable. They can sell it as safety. They can sell it as timing. And, we're talking about, I think, something like $2,000 a car in silver, $2,000 a car. So who's going to buy it first? Let's assume that they do it right now that way. It's going to be high end. It's going to be rich people, the same people that are buying, hovercrafts and mini helicopters, it'll be those people. But eventually it'll become more used. I mean, another example. Anyway, I just want to say that that's real. It's going to happen, but there is a price where it's just not economical. Like if silver gets above $250, I don't think they do it. Like I think they look for silver substitutes, just like they're doing with solar. So, yeah. But no, it's real. It's certainly, look, let's pretend I don't believe it's going to happen. Okay. Right. But now it's in the news and I got to buy silver for solar. I'm a Chinese company. I got to buy silver for my solar. I got to buy silver for my investing coins, my pandas. And I got to buy silver because the CCP wants me to, because I don't know, they just told me to, right? And so when you see a newsletter like that, what do? You go out and you buy silver. The industrial side of the business is going to get hurt really badly from all this stuff. The regular electronics. Electronics are going to go up in price. To your point about supply chains earlier, supply chains are reassembling. And when they reassemble with higher costs of procurement of raw materials. And that's what we're starting to see.
Yeah, no, it is interesting because you can kind of, for anyone who's watched the video, you can tell like the AI side of it, but also some of the like hyperbolic comments he's making throughout. It's like, okay, there's a motive here, but I wasn't familiar with the technology. I found it kind of interesting. So I had to do some digging on that separately, but moving on to platinum, I think that's one of the things that's kind of been overshadowed by silver lately, because everyone's like, a lot, even the precious metals guys are like, hey, like, look at this and what's going on in silver. It's all this, like, all different headlines and rumors and whatnot. Yeah. And platinum is quietly knocking on 1,800 an ounce, and that is roughly the highest level we've seen in that one since, I think, 2011. And what are your thoughts on that one? Maybe we can also chat a little bit about palladium while we're at it.
Well, why don't I just start with platinum palladium as a pairing, and then we'll just move to platinum.
All right.
JP Morgan put out a nice report on precious metals, a 2026 outlook, and a couple other banks did. But when you take the banks and you combine them and you look at what is really happening out there, platinum is at a price right now where it's justifiable to bring more supply online, and that sounds bearish. Palladium is always at a price to bring more online. The problem with platinum is there's not a lot of new supply coming online. The people who mine it don't think it's worth ramping up their production because even they don't believe in their own metal in this consequence. So some of them don't. So what they're doing is they're doing like they do in silver. They're leasing platinum to make delivery from someone else, and the platinum is emptying out. So that's the first thing. Platinum is now, I'm kind of paraphrasing Dan Gali at TD Bank or TD Securities, where he says platinum is probably more ripe for a short squeeze. And mind you, he did call the silver short squeeze. And I think your comment about everyone focusing on silver and platinum's being lost, absolutely. That's a very important thing, because if I'm getting my ass handed to me in silver, right, because I'm playing that game and I'm doing it and I have the same position in platinum, I could probably end up doing it to myself in platinum as I cover. I do believe that there will be more platinum supply coming online based on what I've read, but I don't think it's going to come online for another year and a half. And so platinum is, I think, I'm not an expert on platinum, but slightly disagreeing with Dan. I think platinum is ripe for a very prolonged rally. It could have a squeeze. I think palladium, because of the geopolitical aspects of it, is going to be squeezed. That's what happens in palladium. So in that camp, I think palladium is good for a spike and then a sell-off. And that's because the demand side of palladium is not going up. The supply side is stable, but the demand side is not going up right now. The platinum side, the supply side is stable with the potential to go up, but demand is ramping up now. Now, the kicker for platinum, why I default to platinum versus palladium, other than the fact that I hate palladium because I lose money every time I play it, is one of the. I think this is significant, and if you're looking at the investor mindset, a lot of the bank analysts, when platinum started to crack like 1,300, crack 1,000 first, right? Then it cracked 1,300, and then they started to say they were comparing platinum now to platinum over the last 10 years. And they were saying there's a lot of demand coming out of China, but the physical demand isn't really there, and $1,300 isn't really warranted given historical numbers, yada, yada, yada. And I was like, no, you guys are missing the point here. See, everyone in China who's been, this is our point about unobtainium, everyone in China who's been buying gold for the last 2 years, they can't afford it now. And what's the net? What are you going to buy next? Silver or platinum? Well, silver has the name recognition, right? The brand recognition, but platinum is rare. It's precious. You can make it into jewelry, although, that's something you may not want to do. Make it into jewelry. And the Chinese platinum demand is investors taking delivery. So I think they're comparing platinum to platinum when they should be comparing platinum to gold. Gold's at $4,000. What are we going to buy next? Let's buy platinum. All the metals are going to rise, starting with the physical metal, all the commodities are going to rise, starting with the metals to their more natural occurrence, to more stable occurrence in nature. And I think platinum is one of them. I mean, I remember when they discovered palladium was a good substitute for platinum. It's like palladium went to infinity and platinum went to zero. And that was it, But now I think platinum has a chance to show its worth. We haven't had inflation like we should have based on these metals. So I hope that helps.
Yeah, no, it is interesting. Maybe we can get into the ratios too a little bit, because I think that's potentially a fundamental long-term driver. But from what I was looking at, some of the research, like they're still projecting like a 1 million ounce deficit for 2026 for platinum. And I think the above ground like inventory is like somewhere between 2 and 2.5 million ounces.
Right.
So, I mean, you keep draining this. It kind of reminds me a little bit of the setup, like looking back on where uranium was, where it's like, okay, we have this above ground inventory. No one really worries about it. And then people wake up like, holy smokes, like this is all disappearing. And then it's off to the races. So, plus platinum is is very rare, right? So it's not something you can find as easily as uranium or stuff like that. But what are your kind of thoughts on what some of these different ratios between the metals and oil, and kind of just looking across some of these different markets? Like, what does that tell you? Because like, there's a lot of great charts on Twitter talking about like gold versus S&P or gold to silver, right?
Right.
Gold to oil,
Right.
silver to
Right.
oil now, where oil is now cheaper than 1 ounce of silver, which very, very rarely happens. I think it's only happened 2 or 3 times in the last 50 years. So
Yep.
what do you kind of see when you see some of those different ratio charts?
Well, one that I've come to like is watching the very long-term ratio between the S&P 500 and gold or the GDX or even silver. And Jordan Royburn got me into those. I used to have a monthly with him where we talk about these things. And it's just a very nice sloping bottom that's breaking out now. And it just says that we're in a regime change of what's more important, real assets or fictitious assets or fake assets. So I look at those. I don't look at those to trade them now, but I look at those to get an idea if the longer term trend is in place. I'll use technicals for longer term trends.
Like a signpost for where we are.
Yeah, exactly. You know, are we at the beginning, middle, or end? Because everything is a sine curve. You know, to mirror the signpost concept, everything is a sine curve. Or at the beginning, the middle, or the end of a move. Are we at the bottom of the S, the middle of the S, or the top of the S? And you know, gold is in the middle of the S, and silver is getting into the middle of the S, and platinum looks like it's overvalued, but it's not. It's at the bottom. So these ratios, I look at that way. And so we're at the beginning of the S in the GDX versus stocks. We're at the beginning of the S in silver versus stocks, those type of things. You mentioned the silver versus oil chart. And it's funny because Michael Hartnett at Bank of America, his weekly report brings that up in very cursory fashion, but I latched onto it. And the point he made was silver hasn't been the same price as gold or higher than gold since 1980, if you back out the fact that it went minus $140 that one time. And so the first thing you say to yourself as an energy person, right, or as an industrial person is, here's an ounce of silver, there's a barrel of gold. How much money can you make off of an ounce of silver if you put it into a solar panel versus how much money can you make off of oil? And so silver doesn't make sense to be the same price as gold. And so the bears will say, well, silver's too high. And I'm saying, no, oil's too low. Oil's too low. And the reason I say that is because, well, last time silver was, oil's too low because it was suppressed by Biden by unloading the SPR. I mean, that was overtly done, right? And the second one is Trump is doing the same thing by cutting deals with the Saudis. Keep pumping oil. I'll make sure the shale doesn't compete with you. Do what you got to do. He needs cheap energy to make his Make America Great thing work. And he's getting that so far. Other things are going up in price, like silver. But Hartnett's point was, take a look at this chart. This chart tells you that Trump's plan is being filled, meaning energy is cheap and everything else is getting expensive. So I think when it's over, energy snaps to how important it is. Unless, of course, we do have nuclear fusion. That's going to happen tomorrow. Or thorium reactors, which actually could happen tomorrow. But I mean, I think in terms of coming back to your point about ratios, the only ratio I look at consistently is gold silver, which everyone does. And I only look at that to see if I should continue being long silver. The ratio that I do look at that almost no one looks at a chart level is gold versus silver versus copper. And it's basically it's basically silver versus copper on a gold chart. And what you find is that you're creating a scattergram. You create a scattergram with it, and the scattergram tells me that there's 4 quadrants. In the top left-hand quadrant, it's silver's cheap relative to gold and copper. In the top right-hand quadrant, silver's cheap just to gold. But little by little, the dots are moving down towards silver being fairly valued versus gold and copper. But that's not going to last long. It's probably going to keep moving down. So I think that without going down a rabbit hole, the way to look at it is to look at what Jeff Gundlach looks at. He looks at gold versus copper versus bonds. That's something he looks at all the time. He looks at the gold-copper ratio versus 10-year yields, and that serves him well. But in general, I don't really look at ratios too much, except to confirm what I see or contradict what I say.
Yeah. Now, it's kind of interesting on copper because that, like we were kind of talking about, you see across the commodities complex, there's breakouts just about every look except for energy. And copper is one of those things where, right, you have people predicting $8 a pound, $10 a pound, like out further, like than just next year. But what do you kind of see as far as like the outlook for copper, just very high level? And because, I mean, you have all these, like basically copper ETFs breaking out to all-time highs. Like a lot of the miners are showing signs of life there. What are your high-level thoughts on that?
We talked about this beforehand, and generally speaking, when I get bullish copper, I buy silver, which doesn't always work. But I do like copper as a market that does what silver does, but is orderly and can be owned without, and you can do it without losing sleep at night. Usually, I think I don't have my level is definitely a high level view. All right, I look at copper right now as the cure for what ails us. We need to rebuild our infrastructure. So let's use nuclear, for example. You got to buy uranium because we're going to build nuclear. Fine, we've done that. All right, you've got to buy reactor companies because fine. Now you've got to buy builders of reactors. Then you're going to have to buy copper. So it's all like moving through the supply chain, the food chain of building our energy back. And so copper is, pretty obviously, whether we're green or not, we need more copper because of the data centers. I mean, we're colonizing space with data centers now. That's the latest, meme, which will happen, just not tomorrow. So for me, I bring it down a little bit closer to reality, and I look at the critical mineral situation. Okay, so I'll give you a catalyst for the next spike in copper, which I think is going to happen. First of all, getting it out of the way, China is a hoarder of copper and they're a user of copper, but they also play well in the sandbox in it. If the demand gets too high, they'll let it breathe. They'll release some in the market. They'll do that more genuinely. They'll turn smelters off. They'll kill their demand. But I think if you want to look at what's going to happen to copper, where the problem's going to come, it's going to come from the U.S., I think. And I'll give you something actionable to think about. The U.S., when Trump started with, what do we call it? Independence Day or the tariffs?
Liberation Day.
Liberation Day, yeah. So Liberation Day was, hey, I'm going to tariff using copper. I'm going to tariff finished materials in copper. And I went to myself, that doesn't make sense. I mean, you want to tariff imports of copper weather vanes and copper bowls? Fine. I don't have a problem with that, but we need the copper cathodes because the copper cathodes are semi-finished products that are needed to rebuild the data centers and the batteries. And that's when copper exploded. And then when copper collapsed, Trump comes out and says, basically, I changed my mind. We're not going to allow finished products in, but we will allow copper cathodes in. And so the market collapsed. Okay. Since then, from someone in the industry, two things have been happening. One, we've been securing new supply chains for copper in Latin America. We've been going, hey, psst, give us your copper, right? And we've been bringing in a lot of copper cathodes. So when we're at a point where we can self-sustain, whether it be we have enough copper cathodes or we have someone who's making them now, I think we're going to put tariffs on copper, and it will screw a lot of people. It will screw, and I think copper will go up, but at that point we'll be insulated. So once we're a fortress, I think copper goes to the moon. I just don't know when or how that happens. So I do like copper for that reason. Like, we will never tariff silver. I mean, knock on wood, right? I mean, we could, but if you tariff silver, you're just killing yourself. I mean, especially if it's used in missiles as much as they think. But copper, we can flex on that. It's like, where do you get copper from? Well, Indonesia and Mexico. I'll use two examples. Indonesia and Latin America, let's say, right? So Indonesia sells a lot of copper. Well, we're not going to buy it anymore. You're screwed. Let's make sure that the BRICS want your copper, buddy. That type of thing. Of course, that kills Freeport. I think they're operating out there in a big way. But meanwhile, we'll have a trade deal cut with Latin America. That's what all this Venezuela stuff is about. So I think the risk, I think the next catalyst to copper's upside comes from the U.S. saying, okay, we got enough copper, and the price goes up. That's it.
Interesting. Yeah, no, I look at it as there's some of these different juniors in different parts of the world, whether it's Canada or Latin America, this is kind of the same thing as silver, where they're not pricing in where I think copper is going, but also like even the current copper price. So I think there's, even if you get a little trickle of money into some of these different mining sectors, it's I think worth having a basket of kind of exposure to some of these different metals.
Yeah, I think, and there's the other thing is, the gold miners are going to start buying copper miners. I think because it diversifies their cash flow, industrial plus precious. It makes them look green, and it shows that they're. I'm joking, but Bank of America 3 years ago said gold's going to go green, meaning gold's going to start buying copper, and then they went into why it makes sense and how they'll get the greenies off their back, but it also made sense because of how they coexist in the planet on the planet, and it also makes sense because look at Freeport. Freeport's a gold and copper miner. It also makes sense because you're going industrial and precious. Look at what's happening. Gold miners there's like a two-tiered market for gold miners now. There's the gold miner that is American, and there's the gold miner that's not. And the American gold miner, is spinning off, or the Canadian gold miner, Barrick, is spinning off their American counterpart. That's happening. So I think these spin-offs to let gold fly freely are going to free up the cash flow to buy copper mines. I think you want to own, you want to own one for dividends. You want to own a company that's got free cash flow, and it's either looking at buying their shares back or not doing anything stupid. You want to own one company that you think is going to be a target, and that's probably a copper company. And then you want to own one company like silver, which is just infinite upside, and let that be your silver, like that type of thing. But I think you need to own one that has a potential to make a big dividend, one that has potential for big upside, and one that has a potential for a takeover. And those are how I look at the three metals.
Yeah, definitely a good way to look at it, because there's the silver junior space, the junior mining space in general can be a minefield with a lot of promoters and a lot of share dilution, all the other stuff where it's like, okay, if you can avoid this and find some good projects, then having a basket is going to work out, because the ones that work, they really work. So
right.
I think it's definitely a space we're looking at.
You buy SILJ. I'm sorry, excuse me.
No, go for it.
You buy SILJ, and then you look at the miners and you say, which one is the kicker? Which one's the one I want to add as a kicker? And then you overweight in one of those or another junior. The juniors and the junior silvers aren't junior.
But it's like Coeur d'Alene and a bunch of others where it's like, not even most of the revenue doesn't even come from silver anymore for a lot of these companies.
Exactly. So you got to find, you got to do your work, and I haven't done the work on miners in years. I don't do it anymore because I went to one too many investors conferences as a fundamental analyst, and you'd sit down with this is back then. This is not now. Like they're changing. Back then it was you sit down with a real junior, and the CEO is like, "Oh, this is a CEO who came from Barrick. He knows how to run a company." I'm not Barrick. I'm just making it up. And you sit down with him, and he does know how to run a company, but he's just there for the money, And I go, "Where's your geologist?" Like, I would want to do the whole fun. Like, you're a fundamental. I would want to do this.
Yeah.
Where's a geologist? Is it a brown field? Is it a green field? All that shit. The geologist wouldn't be there. Like, they're not. It used to scare me. So, in 2012, I stopped buying them, and I didn't start buying them again until recently. And I don't have much. I'm very underinvested. So that's basically it. You got to know what you're doing. Like, look, the world is scared to death of miners because of all the things I just told you. And they're irrationally scared of miners. If you burn your hand on a hot stove, you don't burn your hand again. That's what they're doing. But there are a million cold stoves out there that they're not touching. And that's what's going on. There's a lot of undervalued miners out there. I just don't know which ones are the ones you want.
Yeah. No, I've been doing some digging. It's a little bit of a basket approach, but there are a couple that I'll share if we hop off.
That's what I'm here for, to find out what you know.
Yeah, we can get into it. But as we're starting to wrap up here, I do want to get kind of your one last high level thought. Like, what are going to be the biggest things you're paying attention to as we look ahead to 2026 in financial markets? Can be specific commodities or different things. Like, what is at the top of your radar heading into next year?
Okay. Not at the top of my radar, but something I'm starting to look at heavily is putting my money where my mouth is. If I think all commodities going to rise, oil might be the last one to rise. But I want to start looking at vertically integrated producers in oil. The thing that's really on my radar, and it's really high level stuff, but I think I can explain it because it's fresh in my mind. This is very macroeconomic here. All right. I believe that the great financial crisis in 2009 was a shot across the bow of the way that we were running things since Bretton Woods. And the way that we were running things since we broke Bretton Woods in the 70s was debt is how you create growth. And that ran into a brick wall in 2009 with the housing collapse. And we realized that we can't borrow as much as we could. Now, if that was a warning shot, the COVID 2020 problem was the beginning of the new regime. And the new regime is, and this is a commodity regime, the new regime is in the 80s, 90s, O's, and 10s, borrowing money could create growth. Money was cheap. In the 20s, 30s, and 40s, you need to own earning assets to make money. So I think we're going to have a higher natural level of inflation, 3, 4, 5, a higher natural level of GDP, 5, 6, 7, and a higher natural level of unemployment as AI kicks in. And so what I'm getting at is AI will make people not buy. AI will make people will keep wage pressures on everyone. Assets that throw off cash are going to be worth a lot more than paper stocks moving forward. I'm not saying to go out and buy a real estate property for renters. What I am saying is that ownership matters.
Stuff that is profitable today is worth more than Carvana or whatever other tech stock that's going to be big in 10 years.
I just did a very long piece on this, and basically since World War II, we had one regime, and that was after World War II to 1971. It was the welfare state to fight communism, right? And then from 71 to 2009, it was the borrow state. We just leverage everything, leverage what you have. You want a car, you get a car at a 0% loan. They're just pushing cars, right? The metal didn't matter. Now it's like, what's your car loan? 7%. Well, why? Because you have to own an asset that throws off cash to make money, or an asset in general like gold or silver. And so I believe that the backdrop for my comment that commodities will catch up with gold is solid. So what I'm looking at, to answer your question, is I'm looking at incremental signs that that's happening. Trump, his one big better bill budget, that was an incremental sign. There's things in that make me see that. Second, the government is about to change or deregulate loans for small businesses so that they can buy more things. That's a sign. And I believe that we're probably closer to 1975, 1976 than we think, meaning it's the end of it's the beginning of a bubble era. And if you don't own assets that make money, you won't be able to survive inflation. And so I'm going from gold to silver to copper to energy, and that's it.
How does rates factor in? Because you mentioned inflation, you mentioned some of these other things. Like, what's your kind of view on rates in that picture?
That's a hard one, because that's why I picked commodities this year, because I think they're independent of rates because it's demand driven now, as opposed to cost of money. I have something on my mind that I'm looking at, and I had a very good trade last year in rates, but this year I've been just focused on oil, and I mean on gold and silver. Freudian slip. I'm looking at oil again. The rate situation, I think, is I can tell you what Powell's thinking. I think I can tell you what Powell's thinking, and that will be a guide for what rates are going to do. All right. The most important thing to Powell right now is the 10-year yield, maybe the 20-year yield, but longer term bonds. And if he has to, if things get bad enough, he will do yield curve control. We do not like seeing yields rise while the Japanese government bond yields are rising, because that's a sign that they're dumping our bonds to strengthen their currency. But staying on point here, the Fed just started something they're affectionately called in the zero hedge crowd, which I'm a part of, not QE, and not QE means it's QE, but we can't call it that. And as a curve person, you understand curves. We're now borrowing at 90 basis points. I mean, we're now borrowing at 90 days. And the Fed is now buying bonds at 3 years. So the 90-day to 3-year part of the curve is being controlled. That is yield curve control. And the fact that he's doing it now, you can make the case, it's a recession coming, it's very bad. If he has to do it, fine, I don't have a problem with that. But he ain't letting yields go up in the back, because this is an effect of that, moving back. And so what I would say is Powell is very, very, very protective of rates. And so I believe rates stay relatively low. I believe the pain for rates comes out in weaker and weaker dollars, because when you do yield curve control, you stop this part of the curve, you stop that part of the curve, and the air comes out of the balloon at the front, and the dollar goes down.
The money printing, that's the favorite of some people on Twitter and zero hedge.
Yeah, exactly. The Powell meme, the GIF.
Yep.
That's a great example. I mean, but here's the kicker. That's what Powell's doing. When Powell's gone in 8 months, what are they going to do? He at least kind of feels bad about what he did about the inflation.
All gas, no brakes, basically.
All gas, no brakes. That's right. And there's a piece that I actually did read on Zero Hedge that I'm actually doing a cover piece on myself. Is that there's an analyst at TS Lombard, one of the partners there, Stephen Blitz, and everyone's been talking about the Fed might be compromised. Well, the Fed's been compromised. The Fed is being folded into the Treasury. You've got the Fed is going to be an arm of the Treasury, which means you'll be borrowing at 90 days. You'll be issuing 90-day T-bills and buying 3-year bonds. And in 10 years, we'll probably own even more 10 years. Stable coins will help that. So I guess what I'm trying to say to you is I don't have a strong feeling on rates, but every time rates pop, I assume that the Fed's going to act quicker. Every time the dollar drops, I assume the Fed doesn't give a damn as long as stocks are up. So I'm playing rates by being short dollars.
Yeah, I think that's the great debasement trade, as some people have started to call it. But I think it is a very interesting setup looking ahead to next year. And there's I think a lot of opportunities in some of these different sectors. So if my listeners are looking to find your work, where can they find you on social media and on Substack?
Yeah, on Substack, it's Goldfix. It's actually VBL, Victor Boy Larry, my initials, Goldfix, on Substack. And that is a very frequent newsletter. It's an acquired taste because we cover a big tent from fundamentals to secular to intraday stuff. So you have to be prepared for that. Signing up for free or signing up for premium is fine. On social media, just look up VBL's Ghost. I'm not going to tell you my letters. Just VBL's Ghost. That'll work fine. But also be aware that Twitter is or X is also an acquired taste. I do drop a little bit of dark sarcasm on there. So that's it.
Yeah, I'll include links as well, but definitely worth a follow in both places. So before I let you go, I do have to ask my traditional closing question, which is, what book should I add to my reading list? You give me a bunch of good ones before and a bunch of different topics. So what's at the top of your list now?
Thank you for the heads up. Well, the first thing I'm reading is Absolute Batman because my son recommended it. The second thing is it's a reread of this book, The Tower of Basel, which is about the Bank of International Settlements and how they operate and how instrumental they are in markets, especially gold and now silver. And it gives the history. I like the history of markets through an entity, whether it be a biography or an entity like the BIS. And that's something I have to reread because the BIS is in the process of abandoning Europe, I think, and aligning with China the way things are going. So I want to see their politics. That's all.
Interesting. Yeah, there's a lot of different things going on. I think it's one of those times where you have decades happening in weeks and like all the famous things, but it's definitely an interesting time to be alive. So I appreciate you taking the time to come on. We definitely hit on all the topics I want to get into. I think people will definitely find kind of your knowledge and background on the precious metals interesting, and definitely appreciate it. So I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.